Welcome to the latest edition of Fundamentals, where I'll be looking at one of the best-selling tracker funds on the AJ Bell Youinvest platform at the moment, namely Vanguard S&P 500 ETF. An ETF is designed to track the performance of the underlying assets and deliver that performance minus any running costs. This particular exchange-traded fund, or tracker, is following one of the US stock market's best-known and broadest indices, the S&P 500. Vanguard S&P 500 ETF uses physical or direct replication to generate performance, so it owns the underlying securities, which in this case are some of America's biggest firms by market capitalization: Apple, Microsoft, oil giant ExxonMobil, Amazon.com, and healthcare specialist Johnson & Johnson are the 5 top positions. By sector, tech, financial services and healthcare are the biggest areas. By contrast, basic materials or mining, real estate and utilities all play a relatively minor role. The tracker comes with an ongoing charge figure of just 0.07%, so it's very cost effective. According to data from Morningstar, only 2 trackers from ETF provide a source that are cheaper out of a field of nearly 90 looking at large cap US stocks. The Vanguard product is huge, with just over £14 billion in assets under management, so it should be pretty liquid, at least under normal market conditions. This particular instrument comes with income units, so any investor buying it will have any dividends paid out in cash on a quarterly basis. The yield's around 1.7% right now. The tracker's just coming up to 5 years old and comes with a 5-star ranking from Morningstar for those who place importance in such things. The chart here shows the tracker's performance since launch. So those are the mechanics, not particularly different from when we last looked at this very popular tracker some 6 months ago. So the questions are, has anything changed since? And why would your fellow investors be buying now? And in answer to both questions, I think there are 3 issues to consider. First, US stock markets have begun the year strongly amid ongoing hopes that President Trump's tax-cutting, infrastructure spending and deregulating reform plan will boost the American economy and corporate earnings. Earlier in March, all 4 key American benchmarks, the Dow Jones Industrials, Nasdaq Composite, Russell 2000, and the one being tracked here, the S&P 500, all set all-time highs on the very same day. Just the sort of trend that can exert a strong gravitational pull on the minds and wallets of investors. Second, America's central bank, the US Federal Reserve, is raising interest rates to ensure the economy over there doesn't boil over, but it's doing so slowly, creating the impression almost of a Goldilocks economy, not too hot to force a rapid increase in borrowing costs and returns on cash, as they could suck money away from stocks and into cash or bonds, or too cool so that corporate profits would disappoint. The Fed's raised interest rates 3 times so far in this upcycle, but between 2004 and 2007, the central bank pushed through more than a dozen one-quarter rate point rises and the US stock market went higher anyway. Our research on the last 8 US stock market peaks shows they were preceded by an average of 7, 8, 9 rate hikes, not 3, as we've seen so far here. Although if the Fed sticks to its script of 2 more this year, 3 next, that would take us to 8. Interesting. Third, in the end, the tracker fund is cheap to own. As already noted, it provides broad exposure, taking away the stress of stock picking in return for an annual ongoing charge figure of just 0.07%. Keeping the costs down is one good way of helping long-term portfolio returns. This is not to say, however, the tracker necessarily suits everyone or comes without risk. There are some dangers. First, Trump has just had to retreat on his healthcare reform plan after the Republican Party refused to sanction it in the lower House of Representatives, let alone the upper one, the Senate. This does create some doubt over what he can achieve in terms of tax, infrastructure and deregulation. Second, don't forget that trackers such as this will follow the S&P 500 when it goes up, and if and when it goes down. That's how they work. And I should tell you that on a market cap to GDP basis, it's only the US market has only been more expensive on 2 occasions in 60 years, 2000 and 2007. Both episodes were followed by nasty falls. Third, politics does not ultimately drive stock market returns. Company cash flows and valuations do. Just think, George W. Bush was seen as pro-business, but the US stock market, as benchmarked by the Dow Jones Industrials, went down during his 8 years in office. Bill Clinton and Barack Obama were seen as anti-business in America, and the US stock market soared while they were in the White House, as we can see here, president by president since 1948, with Democrats in blue and Republicans in red. Politics makes no difference to stock market returns. In sum, Please do your research before you put any capital at risk, and only you and you alone can judge whether you think Vanguard S&P 500 ETF ultimately fits with your own overall strategy, target returns, time horizon, and appetite for risk. Thank you for watching, and I look forward to seeing you next time.